welcome. Good morning, everyone. Thank you so much for joining us today. My name is Shonda Harris, and I'm a business opportunity specialist with the Columbus District Office of the SBA. And we are grateful that you are taking time out of your schedule to join us for today's webinar. We're really excited that we get a chance to talk about bonding today. And we get a chance to give you information as far as doing business with the state and bonding opportunities and loan programs, as well as information about the federal government. But before we kind of get into that, just a couple of housekeeping things and just to get us started. Today's webinar is part of a series of webinars that we're doing leading up to the Ohio Business Matchmaker. And some of you may be aware or you may have learned over the course of these past few days. The Matchmaker is our signature contracting event that will be held in Dayton in July 13th and 14th. And it gives small businesses an opportunity, perhaps if you're doing business, maybe in the private sector, or maybe you just have commercial clients and you want to start doing business with the government. Well, the Matchmaker is actually the perfect event for you. You will get a chance to learn about doing business with federal agencies, state government agencies, as well as local county and city government entities. So with that said, we are putting on these webinars to kind of help you gain a little bit more information about the Matchmaker and how you can prepare to do business with the agencies. When you get there, you'll get a chance to give a pitch or give a chance to talk about your capability statement and what you have to offer as a small business. And then hopefully, if that agency has a match for whatever services or products that you provide and they're looking for that, and there could be some opportunities for you. So with that, these webinars are a chance to give you that opportunity to learn how to do business and how to prepare for the Matchmaker. So without further ado, this session is being recorded, and today we do have a double header today. So our first session, we are going to learn about bonding. So if you are in construction, your construction related company, a lot of projects have bonding requirements. And so at the state level, they do have bonding programs to assist small companies, as well as different financing access to capital programs. So for our first session, we do have Chandretta Boykins, who's a business solutions manager with the Ohio Minority Business Development Division at the state. She's going to talk about the programs that the state has, and then we will have a presentation about federal bonding and SBA bonding program. So without further ado, Ms. Chandretta, if you want to come and take the screen. If you do have questions, you can go ahead and put them in the chat, and we will answer the questions as Chandretta goes along and whenever she has a break. So thank you, Chandretta.
Thank you, Shonda. Good morning, everyone. I'm very happy to be with you all today to talk about the financial programs that the state of Ohio has to offer, not only our bonding program, but also our loan programs here. So if you give me a second, I'm going to go ahead and share my screen, and we will dive right in. Okay, so as Shonda said, my name is Chandretta Boykins, the Manager of Business Solutions and Outreach for the Minority Business Development Division in the Ohio Department of Development with the state of Ohio. Access to financial assistance. So a frequent obstacle that a lot of minority women-owned businesses have is the lack of capital. So capital allows you to grow your businesses, not only grow your businesses, but to sustain your businesses as well. Especially coming out of the pandemic, a lot of minority women-owned businesses just needed to shore up their businesses or to sustain to get them over the hump, not even to start back the growth or regrowth process. And our financial programs have been able to help businesses do that. So we have a total of 6. We have our Minority Business Bonding Program, which provides surety bonds up to $1 million to approved state certified minority businesses. So MBEs, and you'll hear me use that acronym throughout the presentation. So an MBE is a minority business enterprise. We have the Minority Direct Loan Program, which provides funding up to $1.5 million for eligible projects, such as the purchase of land, the purchase of a commercial building, machinery or equipment, and our rates are 3% for the loan, for the state's loan, for the state's portion of the loan. What that means is that we only fund 75% of the total loan program or the total eligible project, which I'll get into a little bit later when I dive into these programs. We have the Collateral Enhancement Program, which is also known as CEP, which provides lending institutions with cash collateral deposits to use as additional collateral support for loans made to eligible small businesses. So our CEP program, we don't deal directly with the client. The client deals with the bank. And if there's a collateral shortfall there, then the bank that is approved lender with the state will contact us and we'll kick in the additional capital to cover whatever the collateral shortfall is. Our Ohio Capital Access Program can provide funding up to $350,000 for land, building, machinery, and equipment purchases. It can also fund working capital for inventory and payroll up to $250,000.
Excuse me, Chandretta.
Yes.
I don't know if you're able to make your screen, put it on presentation mode. And then also it looks like it's just still on the first screen.
Does it? I have
your slides, yes.
Before. Let me stop sharing. Hold on one second.
Okay.
Let me try it again. That has happened before. I don't know why it does that with Zoom.
There we go. Yes.
Now you can
now
see
it's full screen now. Yes, thank you.
Okay, perfect. I'm sorry. It was full screen on my side. So my apologies.
That's okay. Thank you.
In September of last year, and I got with the state in June of last year, and was very instrumental and influential with these 2 loan programs. So I absolutely love them. We've been able to alter them since September, as well as the market changes and the demand of our customers' needs change, because these are policy programs and not statute programs. So these are not the law. We're able to go in and adjust them again, as market conditions change or the needs of our clients change. So our first is the Ohio Micro Enterprise Loan Program, which helps stimulate the growth of new and existing minority business enterprises and women-owned business enterprises. The micro loan is 0% interest, and the minimum loan is $10,000. The maximum loan is $45,000. This is a working capital loan. Again, as we go through, I'll dig more into the specifics about the loan. But we have been able to, I think it was on Monday, we hit a milestone. We have done 50 micro loans since October of last year for $2,080,000. And so we've been able to inject that into the economy in Ohio for minority and women-owned businesses. And then the Women's Business Enterprise Loan Program provides loans to women-owned businesses at or below market rate. The high interest rate on that is 3%. That is if you are not certified as a women's business enterprise. However, if you are certified as a women-owned business enterprise, the interest rate is 1.5%. The minimum loan amount is $45,000 and the maximum loan amount is $500,000. Okay, so our Minority Business Bonding Program, again, our office provides bid, guarantee, and performance bonds to certify MBEs. This helps increase contracting opportunities with private, local, state, and federal entities. Bonds are administered under a bonding line, and those lines can go up to $1 million. The lines do expire after 12 months, but can continually be renewed. there's a 2% premium for each bond requested under the approved line. So you can have multiple bonds under that $1 million, but say you have a opportunity and you only need to pull $100,000 for that particular job, then 2% of that $100,000 would be $2,000. If you needed to use the entire million, then that would be $20,000 would be your premium. And those have to be paid, of course, before the draw can be made from the bonding line. There's no application fee. There's no job creation retention ratio for that. A lot of federal programs, I used to work for the Women's Business Center, which was governed by the SBA. And sometimes there was a job retention and creation ratio for a lot of the products that we had that were funded by the SBA. A working capital line of credit is required for at least 20% of the requested amount. So what that means is in the business name, you would have to have a credit card or an actual line of credit, some kind of revolving line where that was at least 20%. The limit was at least 20% of the requested bond amount. Bonding lines are recommended for approval on the 4th Tuesday of every month. So a lot of people think that bonds are at immediate, but even after you apply and they're decisioned, there goes to our Minority Development Financing Advisory Board. We affectionately call it MDFAB, which meets the 4th Tuesday of every month. And then they have to decision it as well. So there's an internal decision by our underwriter. There's an external decision by our MDFAB board. And then there's a third decisioning, which is also external by the state controlling board. And then all three of those entities have to approve in order for you to be accepted. So MDFAB meets the 4th Tuesday of every month, and the controlling board meets 1st and 3rd Monday of every month. So they're kind of back to back. So you don't have to wait typically too long. The turnaround time is usually 45 to 60 days from application to final decision. That's to say decision versus approval, because we do decline some clients. So about 45 to 60 days. Any questions about the bonding program before I move on to our financial programs? It's really pretty simple. Again, there's an application that you have to fill out. Once your application is complete, our credit analyst will review your application and supporting documents to make sure that you submitted everything. If there's anything missing, she will contact you and say, hey, I'm missing this. You submit that, she checks it off the list, and then she sends it to the underwriter when it's a complete package. We don't halfway submit the package because then that'll prolong the decision for you. So once there's a complete package submitted to the credit analyst, then it goes to the underwriter. She'll take a look at it. If she sees or he sees that there is something that's missing or something that needs to further be explained, then they will reach out directly to you. Once that information is submitted, then they will decision it internally. If it's done by the 2nd Tuesday of that month, it will go on the agenda for the 4th Tuesday to be presented at MDFAB. We do ask that you're present at the MDFAB meetings in case the board members have specific or particular questions for you. Sometimes they'll ask, how did you get in this industry? Other times they'll ask about your financials, if there are questions there. So you may be asked to advocate on your own behalf for that. And then once that goes from MDFAB, we'll submit that to controlling board, and that'll go on their agenda for their next meeting. Once they meet and decision it, then I contact you with whatever the decision is. And once the bond is administered, you're able to pull from the line as you wish. Now, some people have a bonding line with no prospective contracts coming up. They just have it in case something comes up, and then they don't have to rush to get it. Some jobs, as you know, may not have that 45 to 60-day grace. You may need it, you know, in 24 hours or 48 hours. And so they have it there kind of as an insurance policy, for lack of a better term, that I don't need it right now, but in case I need it in the future, I have it available. So I'll be quiet now and see if there are any questions.
No, we don't have any questions so far in the chat.
Okay,
Chandra.
perfect, thank you.
Mhm.
So now we'll talk a little bit about our programs, which you can have a bond line and any of our loan programs. You can also have multiple loan programs as well. So you could have a minority business direct loan program and a micro loan. You could have a minority business direct loan program, a micro loan, and a WBE loan, a women-owned business enterprise loan. As long as you have the capacity to repay all three, then you can have all three. And the reason that is because your needs, the financial need may be different, and the borrowing costs may be different. And so that'll make sense as we go through some of the details about the loan programs. So the direct loan will finance up to 75% of eligible project costs. A minimum equity injection of 10% is required by the borrower. A private lender might be required as well. So if a private lender is required, then they would be responsible for the other 15%. Or the client could say, I have the other 25%, I'll give a 25% equity injection, and I don't want to even deal with the private lender. We'll do that too. But the minimum equity injection by the client is going to be 10%. The minimum loan amount for the minority business direct loan is $45,000. The maximum is $1.5 million, and the rate is 3%. It's simple interest, it's not compounded. The term of the loan will not exceed 10 years for equipment and 15 years for commercial real estate. We will take a shared first or second mortgage if it is a if it is a commercial building that we're looking at. The direct loan has a job creation and retention ratio of $35,000 per job created or retained. There is a $300 application fee and a 1.5% commitment fee once the controlling board approves it. So this loan has 3 levels of approval as well. It's approved internally by our underwriter, just like the bonding line. It's approved, or it's decisioned, I should say, by MDFAB. And then if it goes through MDFAB approval, it will go to the controlling board for final approval. Now the commitment fee, because in our loan program funds, there's a limit there. There's a cap. It's not unlimited money. And so the commitment fee says, I'm not going to hold this money up. I'm committed to this loan. I'm committed to getting this funding. And so we remove that capital from the fund. So we know how much we have left to borrow. To lend. We know how much we have left to lend. And so when you pay that 1.5% commitment fee, and that's of the loan amount, then we know that you are committed to taking those dollars. So again, we know exactly how much money we have left in that fund. But you don't pay those fees until after final approval from the controlling board. Direct loans, and they of course have to be paid before disbursement of the funds. Direct loans are recommended for approval again at the MDFAB board meetings on the 4th Tuesday of every month, and then state controlling board as well. And nothing will be done, no project commencement, no funds disbursement until state controlling board gives the final approval. Any questions about the direct loan before I move on?
No, I think we're good. No questions so far.
Gotcha. Collateral Enhancement Program, also again affectionately known as CEP. It supplies pledged money market accounts to lending institutions to cover collateral shortfalls of individual small business loans. Money market accounts reduce proportionately with the principal reduction of the small business loans on an annual basis, and is used to offset losses a lender incurs if loans default and or there's liquidation. And so again, as I explained in the beginning, a customer walks into maybe a new business owner, a startup walks into a banking institution or CDFI, and they say, hey, I'm starting up a business. These are my projections. This is what it looks like. I'm going to make over the next 12 months, 24 months, 5 years, whatever that institution asks for. Here's what I have now in assets or cash. But there's a collateral shortfall. That financial institution, if it is one that partners with the state or is on our approved partner list, will then contact us and say, hey, this looks really good. This person has great credit. They have a great business plan, great idea. Their financial projections and assumptions look well. We want to do this loan for them. However, it's brand spanking new. There's a collateral shortfall. What does the state say? If the underwriter feels good about the deal, then again, they partner with that particular financial institution, and they will kick in whatever the supplement is to make sure that they have collateral coverage for the loan. The kind of the mechanics and the terms. So the length, there's a maximum length for the CEP deposit, or our allocation is 5 years. And so we support some CDFIs across the state, and most of their loan terms are 60 months, which of course is 5 years. The loan length, the maximum term for real estate loan again is 15 years. Maximum term for equipment loan is 7 years. Maximum term for short-term working capital line of credit is 1 year. And it can be renewed. Now, these are the rules set by the financial institution in partnership with the state. And then the interest rate is going to be determined by the lender. So our money goes to the lender, and then the lender sets the rate at which you pay the lender back for. You will not pay us in a separate transaction. Our dealing is completely with the institution, not with the client. So the lender is going to determine the interest rate. We have I call it the cousin program to CEP, which is Ocap. And feel free to put questions in the chat or come off mute and stop me at any time if you have questions. Ocap, which is our Ohio Capital Access Program. The loan portfolio insurance program for lenders, that's what it's also known as. We assist small businesses, for-profit and nonprofit, to obtain credit for growth. And so the biggest difference between Ocap and CEP, or I should say one difference, is that CEP is for-profit businesses only, but Ocap is for both for-profit and nonprofit businesses. It's been around since around 2002, and we've enrolled more than 1,080 loans. We're probably up to 1,095 right now. I think we've done probably 15 since this slide was created. Borrower contributes 1.5% to 3% of a loan into a reserve fund held by the lender, and the lender matches the borrower contribution. And then the state kicks in the rest. So if you are a MBE, then we will give you 80% of whatever you are requesting. The Ocap reserve fund is also available to cover losses on any loan in the lender's Ocap portfolio. So again, you have to be on the approved financial institution list, whether you are a CDFI or whether you are a banking institution or a credit union. Some credit unions cross over as CDFIs as well, but you have to be on an approved list in order to qualify for our Ocap program. Again, this is not a customer-facing program. This is a program that if you go into a financial institution that's approved by us and you say, hey, I have this idea, or I need a business loan for this. This is what I'm looking for. If the lender is on our Ocap list and they want to partner with the state to make this deal happen with you, maybe it's too risky, they don't want to assume all of the risk, then they will call the state and say, hey, we really want to help this person, but it's risky. Can you partner with us to be able to give them these funds? And again, we will give that capital to the financial institution, and then they will create the terms by which you pay back and the interest you pay on that loan. So the criteria for Ocap, lines of credit, fixed asset financing and refinancing. Maximum for fixed asset financing, which is machinery and equipment, real estate, is going to be $350,000. Working capital max is going to be $250,000. The max term for real estate is 15 years. Max term for equipment loans is 7. Max term for short-term working capital is 1 year, so 12 months. Again, the interest rate is determined by the lender, and some borrower requirements that we have negotiated with our approved Ocap financial institutions is you must create and retain jobs as a result of this loan. You're going to pay the lender's normal application and closing costs. Must be an Ohio business with less than 10 million in gross revenue and fewer than 250 employees. And again, it can be used for for-profit and nonprofit businesses. So this is a great help to churches and religious institutions, nonprofit childcare, advocacy agencies, so on and so forth. And here's a list of our participating lenders, just so you guys, based on where you are in the state, have this information. So Century National, Fairfield National, Farmers and Merchant, State Bank, First Knox, First National Bank of Pandora, Heartland Bank, which is a big one in this area that we do a lot of business with. Park National is one as well. People's Bank, Richland Bank, Security National Bank, Unified Bank, United Bank, and Unity Bank. These are all on our approved Ocap list. Program comparison, again, because these are cousins, I think, of one another, and sometimes are interchangeable. You can also have a CEP and an Ocap loan at the same time. You can have a CEP, Ocap, and any of our other loan programs at the same time. Again, as long as you're able to cash flow and pay back whatever it is that you borrow, you can have multiple loan programs working together along with the bonding program at the same time. So CEP is for-profit entities only, $5 million maximum loan amount, $35,000 minimum working capital. So if you're wanting just working capital, $35,000 is the minimum that you can borrow for. Must document the shortfall. So we must know how much the shortfall is. And we also have to know what collateral you do have. So how much is the collateral that you do have valued at? What's the loan amount? And then we have to document what that shortfall is. There are incentives for MBEs or MSDC certifications. So that would be NMSDC, National Minority Supplier Diversity Council, or OMSDC, Ohio Minority Supplier Diversity Council certifications. Job creation and retention ratio, $50,000 CEP deposit for one job. Borrower revenue maximum is 20 million, and deposit allocation is for a single loan. So, excuse me. When we say deposit or allocation is for a single loan, that means that we are dispersing whatever dollar amount for one single loan, which differs from Ocap. They have a pool of deposits for the people individuals who are applying for the Ocap loan. If you're applying for CEP, then we are funding just that single loan. Ocap, nonprofits and for-profits, $350 max for loan or fixed assets, maximum $250 for working capital, which is huge. There are a lot of entities, our microloan program, which is a 0%, working capital only goes up to $45,000. But there are some entities where more capital is needed for working capital. It could be payroll, $45,000, for payroll is one employee, if that, with some firms. And so sometimes there needs to be some additional funding for working capital, for inventory, so on and so forth, especially if there's multiple things that you need to do with the working capital. So Ocap may be a solution over the microloan because the working capital limit is much higher. There are incentives for state certified Mbes only, no job retention or creation ratio, and then borrower must have a maximum of $10 million in revenue. So there is a cap of who can help based on how much revenue they bring in. Now, the Ohio Micro Enterprise Loan Program, again, one of the loans that I helped to stand up and determine the terms for. They are, again, intended to stimulate the growth of existing businesses. These businesses must be certified as minority business enterprise or women-owned business enterprise. Minimum loan amount is $10,000, max is $45,000. Interest rate is 0. Businesses must be current on all of their taxes and their loans. If it's a loan in the business name, we are going to verify that it is, because when you, on your personal financial statement, you still have to list anything tied to you personally. So we'll verify that those loans are current. Businesses cannot have defaulted on any previous financial assistance program through our department. So what I will stop and pause and say right here is that for none of our financial programs, that's the bonding line, or any of our loan programs, do we check your personal credit. We are going to base our decision on 2 things. One is, how do you cash flow? What is your historical financial data? And what are your projections? Do they make sense? If you have a business selling VCRs and you say, well, I'm projected to do 1.2 million in the upcoming year, that doesn't make sense, because who has a VCR? Who has VCR tapes? Who's selling VCRs? So we will not approve you based on that, and it's all together. It's not one or the other. So even if you're able to cash flow, if your projections are off, we will not approve you for the loan. So the cash flow has to be there, debt coverage has to be there, historical financial data has to be legible and on point, understandable, and then your projections also have to make sense. Interest rate 0%. Business must be current, again, on all taxes, and you cannot have defaulted on any of our previous financial assistance programs. This is 100% working capital. So any business expense, you can use this for inventory, vehicle purchase, which is something new. We used to didn't do any type of rolling stock. The vehicle does have to be commercial. It cannot be mixed use, and it cannot be a consumer. It has to be a commercial vehicle. So if you find a $40,000 dump truck or something like that, that is zone 100% commercial, then you can purchase that at 0% interest under this microloan program. It can also be used to refinance business debt, which is something that we recently added as well. There's a lot of high interest business debt. There's a lot of predatory loans out there on business and consumer side, but on the business side specifically for the purposes of this presentation. So to be able to refinance that debt, if it's $45,000 or less at 0% interest, is a great add. It's going to help with cash flow in your business, and it's also going to help you restructure your debt position as well. So the microloan, and maybe it's just because it's one of the loans that I help stand up, is probably my favorite loan out of everything that we offer our clients. The loan proceeds may be used again for working capital, machinery, equipment purchases, leasehold improvements, refinance current business debt, rolling stock, inventory, you name it, you can do it under this loan as long as it is for a business purpose. Loan proceeds may not be used for repaying delinquent taxes, financing residential property, owner-occupied or investment property, financing a change of ownership, so no buyouts, no franchising, anything like that, reimbursing funds owed to an owner, partner, or shareholder, financing a non-business purpose. The repayment is 5 years for permanent working capital, 7 years for equipment. So if you're going to have a 5-year loan at $45,000, zero interest, that's going to be $750 a month that you're required to pay back. If you are able to demonstrate that you cash flow in your business or globally, because we'll look at your global financials as well, including if you are not a full-time entrepreneur and you have a job. So if you're able to sustain that payment, and again, your projections make sense, then you're pretty much on point to get the loan. The WBE, or Women's Business Enterprise Loan Program, must be 51% owned and controlled by women or be certified as a women-owned business enterprise. So you don't have to be certified, but we recommend that you are. And the reason why is because the interest rate is 3% if you are not certified. The interest rate is 1.5% if you are certified. Some things that we've been able to change with the WBE certification is refinancing debt. I advocated for that. I sit in the consumer credit space as well. And so I know, based on my research, that women typically have lower credit scores than men, because in the family, we're the shoppers and we assume a lot of the debt. And so when there's a woman who gets a business loan, either from a bank or from a CDFI or something like that, and the loan is tied to their personal credit score, then the interest is higher. Or if people have to go to a CDFI, because that's a second look lender, it's more risky, the interest rates tend to be higher. Then being able to refinance that high interest business debt under the WBE loan puts them again in a better cash flow and debt position. And so we recently added that. I was a very strong advocate. I recommended it, and then we ran it up the chain and it got approved. And so we're excited that we are able to now refinance debt under the Women's Business Enterprise Loan Program. There was a time where we wouldn't do rolling stock either, but as more women are entering the transportation and logistics business, dump truck hauling, excavation, so on and so forth, I said we probably need to look at that as well. And so that was changed. And now under the Women's Business Enterprise Loan Program, we do rolling stock. Again, commercial vehicles, we will not do over the road vehicles, but we'll do dump trucks, or we have a business where they do mobile detailing. So they have a water tank and a vacuum and everything, coming out of the back end of their vehicle. So very specialized vehicle for their business, which is considered equipment at that point because they need that in order to perform their job. So we were able to get that amended, and now we can do that under as well. So real estate purchase, which is probably on the next slide, everything that you can do under the direct loan program, you can also do under the Women Business Enterprise Loan Program. Again, must be current on all taxes and haven't defaulted previously on any of our programs. And then, loan proceeds may be used for machinery and equipment purchases, leasehold improvements, renovations, refinancing business debt. Commercial real estate purchases may not be used for inventory, operating capital. I need to remove that rolling stock because that has not been updated. We can do it for specialized commercial vehicles, repaying delinquent state or federal taxes, financing residential or investment property, changing of ownership, reimbursing funds to an owner, purchasing a franchise or pre-existing business. We don't do that. And financing a non-business purchase. Repayment, 10 years for equipment and machinery, or 10 years for anything other than real estate. So even if it's leasehold improvements and renovations, that holds a 10-year term as well. And then 15 years for owner-occupied real estate. Now, you can have a building, a commercial building, and have tenants in your building, but you have to occupy 51% of the space or more in order for it to be not to be considered investment property. If you occupy 50% or less of the building, then we can't do the loan. It's considered investment property, and that's an ineligible use of funds. And then the final slide is going to have how to get in contact with us based on the loan program that you are interested in. So there are websites there that you can go to and read up more about it. Or you can just email us at the minoritybizfinance@development.ohio.gov and let us know what you're interested in. And we can schedule a loan interview and talk to you more, or a bonding interview and talk to you more about in depth about the terms, the process, and answer any questions that you have. I'm going to stop sharing my slide, I think. Yes. Any questions?
Wow,
I think I
thank you
stopped right on schedule because we got 15 minutes. So that was
That
perfect
was
timing.
really good. That was a ton of information. Thank you so much, Chandretta. If you do have questions, you can go ahead and put them in the chat, or we could possibly entertain if you wanted to come off mic. But one of the things I love, I think we had Chandretta present last year for presentation, and I was unaware of just, I'm grateful that the state expanded some of the programs, the options that they have to offer as it relates to small business and the timing of it. You know, while we're in the midst of COVID and now kind of transitioning out of it. So just grateful for the WBE program and just all the things that the state has to offer to our small businesses. And really, I think that speaks to our state and them and their desire to want to see you succeed. So thank you, Chandretta. I know you were instrumental in getting several of those programs off the ground. So I do want to say thank you. No questions at the moment, but this is someone who said they're grateful to have participated in training and hearing your presentation and hearing all of the wonderful things. Yeah.
Thank you. So, there is something that I'm working on in the future, and it'll probably be way in the future. I said, I hope I'm still here to help facilitate it. I spent 20 years in banking and then some years in nonprofit before I came over to the state. And one of the things, you know, I want the state to be competitive. I don't want the state to put banks out of business, but I do want the state to have competitive programming for those people who are not bankable. And so, because I'll give you a case in point, I have a private client at Chase. That was one of the banks that I used to work for. And I love Chase. It was a great training ground for me, but they are a very staunch lender. So she's a private client. She has money in the bank. She has excellent credit, business and personal. And they will not give her a line of credit.
Wow.
She needs it so desperately for the industry that she's in. And many of our minority businesses could really utilize or do better, have better cash flow and better cash flow management if they had a line of credit instead of a loan. Because with a loan, you have a fixed payment, whether you use all of the money or not, you still have to pay it back. With the line of credit, if you draw what you need and only have to pay that back, then it puts you in a better cash flow and debt coverage position. And so that has been on my radar, one, since I got with the state, but more now than ever, as I look at the trends and where the economy is heading and how that's going to impact everybody across the board financially. A line of credit would definitely be more beneficial. So again, it's not for public consumption. It's not out there, but I will tell you that the state is always looking at how to elevate, how to assist, and how to address the major needs and concerns of minority businesses and others. I just happen to be in the Minority Business Development Division. So my focus is on minority businesses, but we do have a business services division as well. And they are also looking at how to support businesses that fit into their parameters. And so the move is to be very progressive. Before last year, we have 4 programs. They have been around. You saw the slide, the one that had been around since 2002. It's 2022. That's a 20-year-old program. And so as we continue to evolve and they got fresh blood in here like me with new ideas, then I plan to at least make mention of those things and try to run them up the ladder, because having my ear to the ground and being a consumer, as well as a professional, and being a business owner myself, as well as a professional, I can see it from all three sides. So.
Yeah, no, it's just wonderful to hear that. I know with the focus of this administration, with our president and everything, and the focus on really assisting minority businesses, it's good to see that that's trickled down to the state, and then them offering programs, really looking at the needs of our community and what is, what our businesses, and especially I know with the women-owned business, they've expanded that, given the certification, the WBE certification, and now to have the funding to go alongside it is really wonderful to see, and especially in our community to be able to assist the growing diverse population. So I do thank you for that. And just everyone, I do realize that everyone that may be on the call, you may not necessarily fit the criteria for this, but that's okay. There are, as Chandretta said, there's some other programs that have access to capital. If you don't fit the criteria, if you're woman-owned or minority-based, there still are other means for you to get access to capital. And I think what we're going to do, not now, but next fiscal year, our next federal fiscal year starts in October. So sometime in between October and next September, we work with PTAC and we put on a government contracting series every month where we focus on a government related topic and we invite subject matter experts. And we'd love to bring Chandretta back, and then actually our next guest to perhaps focus on maybe a month of doing a series on bonding and construction, and then kind of breaking some things down. There was a lot that was given in this presentation, and I know sometimes some of the terminology, but I think next fiscal year we'll have a little bit more time to unpack everything, and then give a chance to explain a few more things, and then open it up. So again, thank you so much, Chandretta. Yes.
Yes, ma'am. Things are ever evolving, and I'll say this and be quiet. Certifications are huge, not only to take advantage of the funding opportunities with the state, but also the bonding. I talked to a business last night, and yes, construction owners, those are our ideal candidate in that space.
Right.
But because we don't have the line of credit, we will look at other business entities and other business industries for the bonding line. And so because we don't, like I said, have the line of credit in place right now, you can potentially use the bonding line to serve as a line of credit for you as well. So being certified as a minority business enterprise has its benefits, privileges, and advantages in order to do that. And so we're looking at definitely some creative ways to say yes, and instead of saying, hey, no, because you don't fit into this, square box. And so everything's legal and ethical, but we are looking at programs and ways to be able to assist. There may be some other policy changes to our loan programs coming. We're talking and negotiating in that way as well. So again, this is all for your benefit. And with Intel moving in, they're looking for certified businesses. They're looking for certified entities. They're looking for businesses who are doing joint ventures with others. They want to be able to have a business put at least 50 pair of boots on the ground. And a lot of small minority businesses don't have 50 employees. So they're going to need to collaborate, and somebody in that collaboration is going to need to be certified as a WBE or an MBE. Outside of that, Dayton is talking about a company called SimCorp, who's coming from Shanghai, China. And so the deal may be the same kind of deal with Intel. We have Sherwin-Williams has a huge program or project in Cleveland. Outside of their headquarters, they're working on something else up there. And so just all kind of opportunities begin to unfold for you when you're connected to the state through certification or through our one of our bonding or loan programs, for one of our financial programs, I should say. So it's to your benefit to definitely partner with the state, look into the things that we have to offer, even from technical assistance, through our minority business assistance centers. They have a wealth of information, knowledge, and resources. They're a resource for resources as well. So that's my spiel. That's my pitch. Shonda, when you say, I don't know if you're going to send this recording out, but just make sure you send my contact information as well. So if any of you guys want to schedule an appointment or speak to me directly, then I will avail myself when it's mutually convenient. So thanks, Shonda, Sharon,
Thank you.
for the opportunity to speak today. I appreciate it. Thank you.
Okay. Thank you so much, Chandretta. And I'll see if you can send us your slides, because along with the presentation, we want to post the link for link for this presentation, as well as the link for your slides on the Ohio Business Matchmaker website, and as well as the Ohio University PTAC site. So Sharon, if you can put both of those in the chat, you can definitely access this. And again, we're grateful to have the state as resource partners. I know I work for the federal government and work with firms that have federal certification. And of course, typically federal projects are their primary focus, but they do also have to diversify, and they have to have other type of contracts that they have, not just federal. So we do encourage that they do business with the state, local entities, private sector. So this is a great opportunity. Or if you're just getting started, a lot of times we will recommend, thank you, Sharon, we will recommend maybe look at doing business with the city, the state, the county as a good way to increase your capacity, increase your sales, grow your business, and then start looking at the federal government. And then those certifications are, again, just tools to help you get your foot in the door and hopefully gain access to some larger contracts. So again, thank you, Chandretta. And as we transition, that was a presentation on bonding and some of the access to capital programs that the state of Ohio has to offer. So if you're looking to do business with a state agency, a board or a commission, that was the information that was available to you for that. So now we do want to transition into looking at SBA bonding program. And that is for individuals that are looking to do business at the federal level for federal projects, and not just the SBA bonding program, but also opportunities for bonding at the federal level. So we do have Mr. Kevin Keller, and he is a Senior Vice President of Construction and Surety Division with the Fidelity Group. And he's up in the Akron area and been around, just like Chandretta, in this space for many, many years, has a ton of experience, and he's in Independence, Ohio. So we want to welcome him to talk about the SBA Surety Bonding and access to capital, well, excuse me, programs for federal projects. So Mr. Keller, you can take it away.
Good morning, everyone. Thank you for joining us. Can you hear me okay?
Yes, it sounds good.
Okay, good. All right. I see we've got, I've checked out as many of the participants as I could on LinkedIn this morning. I see we have a couple of PTAC people and a couple of contractors. So I'll try to, I'm going to gear my my comments as much as I can to everyone. Let me share my screen here. We'll get my presentation up here and get started.
I love your background and then the Ohio State shirt. So you're you're starting off on the right foot this morning, Kevin.
I'm a Buckeye. All right, let me see if I can get this started here. There's my slideshow. There we go. All right. As Shonda said, I work for the Fidelity Group in Independence. I started my career as a bonding underwriter about 36 years ago. Spent my first 20 years as an underwriter, and then the last 16 years I've been an agent. I owned my own agency along with a partner. and we sold our agency about 5 years ago to the Fidelity Group. We specialize in working with primarily with contractors for bid, performance, and payment bonds, but we do bonding of all types, commercial surety and other things as well. Let's see if we can. All right. I'm going to get right into this. An hour goes really fast, and you can't learn bonding in an hour, but I'm going to try to give as much good information as I can. And if anyone wants to talk more in depth, please feel free to call me anytime. I thought I'd start with this slide here, and why bonding is important. If nothing else, it's important because almost all public construction work in the United States of any size it requires bonding. So if you're going to be a prime contractor doing business with either the federal, state, or local public entities, you will need to be bonded. In addition to those requirements, a lot of general contractors are using the bonding capacity of their subcontractors to pre-qualify them for being able to work as a subcontractor to the general contractor. So even though you might be a subcontractor, not the prime contractor with the owner, you could need to be bonded, even if the general contractor you're working for doesn't require that bond. They want to know that if they needed a bond, you could get one. We're starting to see also, we've seen this increase over the years, bonding required on private construction projects. A lot of banks are requiring that the general contractor that is building a project for their customer who is borrowing a lot of money, they want that general contractor bonded. They want to make sure that if the general contractor runs into trouble, that they're not going to end up, that their loan money is not at risk. If you are a contractor and you are bondable and you are set up for bonding, it really does provide you with more opportunities for a more diverse revenue stream. Not only can you do private work, but you can also do public work as well. Bonding, and I stole this from an old friend of mine, bonding is equal to empowerment and opportunity. If you are bondable, you are more empowered and you are able to increase your opportunities. You may be equal to a competitor in every other way, but if you're bondable and they're not, you've got the edge. Bonding was established for the federal government in 1894 by what they called the Hurd Act. It was the very first law passed requiring bonding for public projects. It did establish performance of payment bond on federal contracts, but it was really not well conceived and fraught with a lot of limitations. So in 1935, Congress enacted the Miller Act. That act requires prime contractors on most federal projects, government projects, to post bonds to guarantee their performance. I see I've got a misspelling in there. It's not air, it should be TATIR. And their performance on the contract and payment to their subcontractors. The bond provides protection for first and second tier subcontractors and suppliers. So if you're a prime contractor and you've got a contract with the federal government, you're going to provide a performance bond that's going to protect the government against your lack of performance or default. But there's also a labor and material payment bond, which I'll talk a little bit about later, that protects your subcontractors and the subcontractors of your subcontractors from being hurt by lack of payment. Most states, individual states, have enacted what they call Little Miller Acts, which define their bond requirements for state work. They differ a little bit from state to state, but generally work in every state and municipality, village, township of any size has to be bonded. So let's talk a little bit about what is a surety bond. And surety bond is a little different than insurance, and I'll point out some of the differences in a minute. But a surety bond is a three-party agreement where you've got the surety company, which is typically an insurance company. That surety company stands next to the principal, who is you, the contractor, to guarantee to a third party, the obligee, or the owner, or it could be a general contractor who's requiring a bond of you, that you are going, that in the event that the principal fails to fulfill the obligation, the surety will step in and complete that obligation. So it really involves three parties: the surety, the obligee, to whom the obligation is owed to, and then the principal, who is responsible for the obligation. And references to surety go back as far as the Bible. In Proverbs, it states, "He who is surety for a stranger shall smart for it, and he that hateth suretyship is sure," or safe. I suppose that could be interpreted a number of ways. The way I like to interpret it is, if you are surety for a stranger, that's the word that really steps out to me. There's a process involved in making sure that the insurance company is writing bonds for someone or a company that is credible and that they should be writing bonds for. And once they go through that process, the individual or the company to whom is going to be principal on the bonds is no longer a stranger. So I believe this really says you don't want to be surety for someone you don't know, someone you don't know anything about, someone who is a stranger. Because if you do, you have a high degree of possibility that you're going to be called to step in and take care of those obligations. But if you know and understand who you're writing bonds for or you're providing suretyship for, you will be safer. And that's the way I read that. I'm sure there's others that might interpret it differently. Prior to recognition of corporate sureties, back, remember 1894, the Herd Act, obligations were guaranteed by individuals. So a lot of times, in order for an individual to come over from the old country, from Europe, they had to be sponsored by someone. And when they got here, they had to work for a period of time for the person who financed them coming over. And there was an individual that would stand behind that obligation to make sure that the individual fulfilled their end of the bargain once they arrived in America. Still today, the federal government does recognize individual sureties. You don't have to have a corporate surety. You don't have to have an insurance company. An individual can provide surety for you. It's not a well-developed concept, and it has a lot of problems, but it is possible. So that's what a surety bond is. You can see kind of a graphic representation of the three parties to the bond, who they are, and that they kind of all are linked together. So a bond is many times misinterpreted, and a lot of people think, well, it's an insurance policy. I'm gonna go get this bond, and it's gonna protect me, but as the principal, but it's not the case. The bond is a protection for someone else. And that's the difference between surety and insurance. A surety bond guarantees up to 100% of the contract amount, but it's not like insurance. An insurance policy is a two-party agreement. Agreement between you, the insured, and an insurance company. If you suffer a loss, which is covered under the insurance policy, you will be reimbursed for that loss by the insurance company. Under a bond, if you cause or suffer a loss, the surety company will come in and make the obligee whole, but then they will turn around and ask for reimbursement by you. So when you purchase that surety bond, you are purchasing insurance really for someone else, to that entity or person to whom you are agreeing to do certain things for. So it's really not insurance. The obligee is the protected party, not the principal. And the contractor principal is ultimately liable for the losses, and you will sign as the principal, you will sign an indemnity agreement agreeing that if the bonding company or surety company comes out of pocket and has to pay on your behalf, that you will reimburse them for their losses. So The key to the whole thing is pre-qualification. The underwriter of the bonding company and the agent doing their work, their due diligence, pre-qualifying the contractor, making sure the contractor qualifies for the bonding, because not every contractor can qualify for that bonding, but if the bonding company does their job and underwrites correctly, their chance of having a default or a loss under the bond is greatly reduced. In your business, you will likely, as a contractor, come in contact with several types of bonds. We break them down in our business into two major categories: commercial surety bonds and contract surety bonds. There are a couple of types of commercial surety bonds that you might end up needing. If you are a contractor who is signatory with a union, the union will allow you, the union will require you to make payment to your employees on a weekly basis, but also to contribute to their fringe benefit funds. But you have to do that on a weekly basis, which can be very hard. But most unions will accept a bond, which allows you then to settle up with on the fringe benefits, maybe more on a more monthly basis. You're still required to pay your employees weekly if that's what the pay period is. But the bond can allow you to not have to make cash payments to the union every week for your what you owe them for health funds, the pension funds, and so forth. So that's one type of bond you might need. Those bonds are not particularly easy to get. In fact, that we can get performance and payment bonds sometimes easier than getting a wage and welfare bond for a contractor. The second type of bond is a court bond. Hopefully you won't need one of these either as a plaintiff or a defendant, but typical kind of court bonds you might run into as a contractor, or one of them would be a release of mechanics lien bond. If you are the prime contractor or even a subcontractor on a project, and one of your subs or suppliers files a lien because they feel that they haven't been paid on time, your contract might and probably will require that you keep the project free and clear of liens. So in order to accomplish that, you may have to get a release of mechanics lien bond to have that lien released from the property, or in the case of public, since you can't lien public property, the funds become lien. You may have to you have to get a bond in order to have that lien released. You may also require, if you've lost a court case and you have a judgment against you, you may want to appeal that judgment. The court will require what they call a supersedious bond or a appeal bond, which guarantees that if you lose that appeal, that the judgment will be paid immediately and any court costs as well. Those are the two probably major court bonds that you might be required to post as a contractor. The third item is the license and permit bond, and those are the most frequent bonds that you'll run into. In order to become licensed as a contractor, either at the city level, state, or I don't think there are too many federal license bonds, but in order to do that, you may need a license and permit bond. Those bonds run anywhere from $5,000 to $50,000. They're easy to get. We have an online system that we can go right online, produce the bond, and even email a lot of those types of bonds to you. Those are written fairly freely and usually cost around $100 for a bond. So those are the easy bonds to get. Those are the more frequent bonds that you might need. On the contract surety side, there are really four subcategories. I'll talk about each one of these: the bid bond, the performance bond, the payment bond, and the maintenance bond. Well, I took some of the slides out, so I'll talk about these quickly individually. I'm spending less time on the actual bonds 101 part of my normal presentation because I want to get into the SBA program and federal economic programs. But if you are a contractor and you are bidding and you need contract surety bonds, you will provide many times a bid bond. That's a bond that is included with your bid to the owner. And the bond guarantees, it's usually written at a percentage of your bid. So for example, if you bid $100,000 to an owner and they require a 10% bid bond, then the bond you give them will be for 10% of your bid, which would be $10,000. That bid bond guarantees that if you are awarded the contract and are required to post performance and payment bonds, that you do that. And if you don't, that bid bond penalty of $10,000 becomes available to the owner to make a claim against, to be reimbursed for their costs in having to rebid the project since you weren't willing to enter into a contract or you unable to provide performance and payment bonds. So it's a small penalty bond that kind of keeps pretenders out of the marketplace. Someone can't just come in and throw a bid on a public project out and with no intention of ever honoring it. The bid bond actually provides a penalty and it kind of provides a little bit of a barrier of entry to the bidding process. If you are awarded the contract and are required to provide performance and or payment bonds, the performance bond is the guarantee that that runs to the owner, guaranteeing that you're going to actually complete the project and you're going to do it according to the plans and specifications of the project. The payment bond, or also called a labor and material payment bond, is a bond that protects your subs and suppliers from non-payment. If you fail to pay legitimate payments, the subs and suppliers can make a claim against your payment bond, and if you owe that money and you don't pay it, the bonding company would have to step in and pay it. And then the final bond is the maintenance bond, which is kind of like a warranty bond. After the project's done, the owner may have a extended period of time that they want a warranty on your labor, your labor and materials or your workmanship. And the maintenance bond will provide that protection to the owner that you're going to come back and fix things that go wrong within that period, that warranty period. And if you don't, the bonding company again would have to step in and do that. So I want to move on to quickly talk about the kind of things that are going to be looked at for you to become bondable. The surety, a little bit like the banking industry, uses what we call the 3 C's: character, capital, and capacity. Character is really, what type of person you are, what's your background. Have you been in a lot of lawsuits? Do you have decent credit? Do you, I like to say, work and play well with others? That's the surety company is going to evaluate that as best they can. They're going to run credit reports on you. They're going to look at your company's history. Do you have lawsuits and judgments against you, tax liens and things like that? The cleaner your credit reports are, the better. Many times the surety will also reach out to others you've done business with, owners that you've done projects for, subcontractors that you use, to get a reference, get references on you through that method. At the end of the day, they want to know that you have good character and that you're going to do your best to fulfill the obligations that you have. Capital, that's clearly how strong is your company financially? Do you have credit available to you in the form of a line of credit or otherwise? Do you have sufficient liquidity to be able to, purchase materials for your project, pay your staff, pay your subcontractors, and so forth? Third one is capacity, and that's simply, do you know what you're doing? If you're bidding a sewer job, do you have any experience installing a sewer? Or do you have people on your staff that have that experience? So they're going to evaluate character, capacity, and capital and arrive at a conclusion, bond or not bond. I will tell you this. I always like to say, if I'm only given one of the three, what's most important to me? And I have to tell you, character. If you don't know how to do something and you don't have a lot of capital, but you have a lot of character, you'll find a way to get it done. So to me, character is the most important of the three. And then I think having the capacity and the ability comes next. If you've got good character and you know how to do things, you can get a lot done without a lot of capital. Capital is, in my opinion, number three. All three are important, but if I had to rank them, that's how I would rank. I guess I had some background on the slides here. You know, what's character, what's capital, what's capacity. So the bonding company now is thinking about bonding you. And, you know, in the past, it was very difficult to get bonding. I started in the business in 1986. And at that time, you had to be in business for 3 years, have profitable results, provide a CPA review quality year-end financial statement. Those are $10,000 and up nowadays. Have working capital and net worth equal about 10% of your maximum backlog of work. Have a line of credit with the bank. Now these requirements could be a little bit more, a little bit less, depending on current market conditions, but generally the barrier to entry to the bonding market was pretty hard. Over the years, things have changed. Nowadays, bonding companies are willing to provide a limited amount of bonding based strictly on your good credit. So if you have a strong credit report, you can get as much as $750,000 single bond for a project just by having great credit without even having to produce a financial statement. So bonding companies have made it easier. They've been with the technology available now to be able to run credit on individuals as well as companies. And with the use of artificial intelligence and things like that, companies have created programs that simply, frankly, just allow us to, we get online, we type in information about you and your company and hit the button and they do their credit reports, and within less than 5 minutes, I can get an approval on a bond. So they've made it a lot easier. But once you get above that $500,000 to $750,000 level, a lot of these other items come into play, and you're going to have to be able to provide financials. You're going to have to have some ability to get credit from the bank and so forth. But you can at least get started. We can get you started at a lower level without financial statements. And part of our job is to, you know, if we bring you in as a new customer and we start with a credit-based bonding program, we're not going to just stop there. We want to help you develop, you know, give you pointers and direction and helping you develop your accounting system so that you can become bondable at a higher level. Number of bond markets out there. I'm going to focus on the SBA market in a bit, but the quick issue bonds, those are what I just talked about with the credit report only. Those are usually limited to about 500,000. I do have one company that goes as high as 750,000. You got to have about like 800 credit score. I don't think I even have an 800 credit score, so I couldn't get a bond up to 750 with them. There are markets that will take collateral from you in order to write a bond. For instance, if you can provide an irrevocable letter of credit or are willing to submit your contract to an escrow arrangement, some companies will write bonds. We consider these a last resort. Frankly, if you have the ability to provide the collateral, you probably have the ability to fund your company and get a bond without collateral. So it's kind of a catch-22 type situation there. The Small Business Administration has a bond guarantee program, and I'm going to talk in detail about that next. And then beyond that, just the standard markets where your company's well capitalized, you've got a line of credit, you've got experience, you no longer need the assistance of other programs or the SBA. You can do it directly into the standard market without any special help. So let's talk a little bit about the SBA program. It's a wonderful program. People complain about government programs and things like that all the time, but I have to tell you, I've been working more than 10 years with the SBA Bond Guarantee Program, and it's just one of those programs that just really works well. The folks at the SBA have been really great to deal with. They have become very responsive over the years. Back when I first started in the bonding business, everything was all done on paper and it took forever. And the SBA bonding program was very cumbersome and difficult to navigate. Of course, I want my competition to still think that so that I'm the only one doing it. But frankly, they've made it streamlined it so much better. They have an online system. It's really been fabulous program for us because we are experts at it. We know how to navigate the program, and we've been able to do an awful lot for our contractors, small contractors, much more than they can get done in the standard market. And we use that SBA to help get our contractors more bonding when they need it early on so that they can jumpstart and really grow their business, and then help them get better so that they won't need the SBA any longer. The SBA loves nothing more than a contractor leaving them because it means that they've been successful, that the program has helped them, and that they can now move on into the standard market. That means that's been a success story for them, and so the SBA likes that. The program was created in 1971 to provide guarantees to bonding companies who are willing to provide bonding to contractors who are unable to obtain bonding in the standard market. So the SBA does not provide the bond, they provide a guarantee to the bonding company up to as much as 90% of the bond. And what that does is it allows the bonding company to lower the bar, knowing that if they do have a loss and they have to pay out a loss, that they're going to be reimbursed by as much as up to 90% of that loss. That allows them to write bonds for contractors who they typically might not write bonds for. There are only a few companies that really specialize, bonding companies who really specialize in working with the SBA, and we do business with those that do. The SBA can provide a guarantee for single bonds up to $6.5 million. And I was just told the other day by a very good source that that's going to be increased to 10 million this year, I think this year. Currently, if it's on a federal project and the contracting officer requests it, the SBA can actually provide a bond up to $10 million. The SBA also has a credit-based or quick bond program where we can provide bond guarantees up on jobs up to $400,000 without a financial statement. We use that a lot. That program doesn't necessarily have a total cap on it, so we can provide a $400,000 bond and then another one and then another one without necessarily reaching a limit. Yet what's unique about the SBA is that their underwriting methods are unique, and they're relaxed to allow for a greater amount of surety credit to be granted to the contractor than they can get in the standard market. One of the keys to the SBA program is that the SBA considers any line of credit that you have, whether it be a line of credit that is in the name of your company or a line of credit that is in your name personally. You can use that line of credit to leverage the amount of bonding that the SBA will guarantee for you. So the SBA goes through the same process that a bonding company would in analyzing your financial statement and determining how much working capital you have. But the key is they will add to what they've analyzed your financials could be at. They will add the line of credit that you have to that, so that you can get additional bonding. Now, for an SBA guarantee, there's a fee that the contractor has to pay, and that's equal to 0.6% of the contract amount. And then the bonding company that writes the bond has to provide 20% of the actual premium paid by the contractor to the SBA. So there's fees to be paid by the contractor and by the surety for the bonding guarantees. The rates on the bonds, we've got a situation with our best SBA bonding company where we start the rate at 3.1%, but it drops to 2.1% after the first 100,000 of the contract, and then it drops again to 1.6% after $500,000. So it doesn't take long for a contract to be large enough that the rate starts to be feel a little better. 3.1% is on the top part of the scale for bonding rates. But if you get you start getting into $200,000 contract using that second tier, the overall rate can be pretty competitive. One thing I want to point out, and this is kind of a shout out to us, is there are a lot of agents who are listed on the SBA's website as participating in the SBA Bond Guarantee Program. But frankly, few of those agents are actually doing SBA bonding. I don't know why the SBA lets anyone and everyone list. They have to do that, I guess. But very few people understand the program. In Ohio, there's probably 2 agencies that truly understand the SBA program, us and one other one that I know of. Now we're a large agent. We're large as far as SBA goes. We've been as high as the 3rd largest agency in the United States for SBA bond guarantees. Last year we were the 7th largest, and in 2018 we were honored as Agency of the Year by the Small Business Administration. So we really understand the program. We know how to navigate it. We know how to leverage the bonding that you need out of it, and that knowledge and experience that we have really helps us with help our customers. So who's a good candidate for SBA bonding? First of all, you must be defined as a small business by the SBA, and to find out if your business is a small business, you would go to I provided this link here, but the link is to the North American Industry Classification System. Sometimes they call it NAICS. And the type of business that you're in, you locate the type of business that you are in, and it will tell you whether your sales will qualify. And if your average annual sales over the last 5 years will determine the size of your company. And if you're a general contractor, you can do up to $39.5 million in revenue, average annual revenue over the last 5 years. Or if you're a specialty contractor like a paving contractor or a electrical or mechanical, you can do up to $16.5 million in average sales over the past 5 years and still be considered a small business. The SBA does consider all the businesses you own. They combine them all together to determine whether you're a small business. So you can't have a big business over here and then start a small business. They're going to look at the combined businesses of any affiliated company to determine whether you're a small business. We can get bonding for businesses that have been in business less than 3 years. And so if you're a new company, the SBA might be a solution for you. If your company has very limited equity or no equity or working capital, again, remember I talked about if you have a line of credit. So with a $100,000 home equity line of credit and no equity in your company, you would be amazed at the bonding that we might be able to get for you. Companies that are experiencing fast growth who can't get the capacity they need. You might be able to get some bonding capacity in the standard market, but they can't get enough. They can't grow because their companies growing a little faster than their balance sheet might be growing. Companies like that would be a good candidate for SBA bonding. And then there are companies that have had and certainly in the last couple of years, it's been a tough market with COVID and other things happening. If you've suffered losses and your standard bonding companies are no longer interested in working with you at the moment, we can use SBA as a place to get you the bonding that you need, allow you to nurse yourself back to health. And then once that happens, we move you right out of SBA back into the standard market. That's what I have on SBA bonding. We can talk more in detail if you want to talk to me individually. I want to talk a little bit about contracting with the federal government. Federal government has established formal goals to ensure that small businesses get their fair share of government work. And all federal government purchases between $10,000 and $250,000 are automatically set aside for small businesses. And other contracts are set aside for small businesses meeting certain qualifications, which I'm going to go over a little bit now. If you want to do business with the federal government, and you may qualify for what they call a socioeconomic or a preference based on economically or socially disadvantaged. This primarily is for minority contractors, African American, and others. There's a whole long list of whether you're socially or economically disadvantaged. The one program is the 8A Business Development Program, and that's a program that you can be in for 9 years. Here's what's needed to qualify as an 8A contractor. Your company must be at least 51% owned and controlled by U.S. citizens who are economically and socially disadvantaged. Personal net worth has to be $250,000 or less, and that's to get into the program. That doesn't mean that after 9 years or after 5 years, and you're in the program for 9 years, that your net worth can increase. So that's getting into the program. You have to be owned. The company has to be owned by someone whose average adjusted gross income for 3 years is $250,000 or less. Be owned by someone with $4 million or less in assets. And the day-to-day management and operations of your company must be managed by that 51% owner. And all principals have to demonstrate good character and show potential for success and be able to perform successfully on contract. So the 8A program opens up incredible opportunities to companies. I do business with a number of 8A companies. These are folks that are doing business in military bases all over the country, for government agencies such as the Coast Guard, the General Services Administration, doing the projects, any federal government purchase that goes through one of the agencies.
Kevin,
Yes.
there's one small change. It's a recent update with the 8A program with the personal net worth that did increase to $750,000. It did used to be 250, but now they expanded it, and so it's just 750,000 for the personal net worth for them to get in, and then they have to maintain that throughout the duration of the program.
I'm gonna make a note of that.
Yeah, and that was a recent change. So
yeah, okay. If there are any other things that are not active, please let me know. I pulled this stuff right off of the website, and maybe that hasn't been updated yet. But
thank you.
That's good. The next, and China, you probably are more versed and probably would present this information better than I can. But then the next one I want to talk about is what they call hub zone, or historically underutilized business zone small businesses, and that business must be 51% or more owned, controlled, and primarily managed by a U.S. citizen, Community Development Corporation, Agricultural Cooperative, Native Hawaiian, or Indian tribe. And that's basically based on where you are located. There are, the government has identified certain areas as hub zones, and they're typically inner city areas that are economically depressed. So if your principal office is located in the hub zone, and you have at least 35% of your employees who live in that hub zone or a hub zone, then you may qualify as a hub zone contractor. And there are jobs that are set aside for only hub zone contractors. Next one, and this is a big one, is the service disabled veteran-owned small businesses. If you are a service disabled veteran or a caregiver and you own 51% or more of your business, you could be classified as a service disabled veteran-owned small business. And there's your qualifications there. You have to hold the highest position in the company. You have to have a service-connected disability that has been determined by the Veteran Affairs or the Department of Defense. And you have assigned a NAICS code for procurement. A lot of former veterans are service disabled veteran-owned small businesses. And that, I think it's been a really good program. All right, those are the key, and I think there are other disadvantaged classifications, but those I think are the major ones. This is my last slide here. What do bonds cost? Well, when you need a bid bond, there's typically no charge for that. You might bid 10 jobs before you get a job. So if you got charged for every bid bond, you might go broke before you get your first job. So we don't charge for bid bonds. Performance bonds, depending on the size of your company, the strength of your net worth, how long you've been in business, and other factors, your performance bond rate might be anywhere from 0.5% to around 3% of the contract amount. Typically, the labor and material or payment bond, the price is included within the performance bond. So we usually issue a performance and payment bond at the same time. The cost is included in the performance bond for that payment bond. Maintenance bonds, the first year of warranty or maintenance is included in the price of the performance and payment bond. Years 2 and beyond that, usually there's a small charge, about 0.25% per year on the amount of the bond. And that concludes my formal presentation. About 45 minutes, so I blew through that pretty quick. I left out a lot of information that I typically use, a lot of detail, but I think that gives you an idea of who needs bonding, what's involved in bonding, and what might be out there for bonding programs for you. And I will entertain any questions if there are any. For you PTAC folks, I'm happy to do this type of presentation. I've also got another presentation that I do on what I call the life cycle of a bond request. The presentation goes from when that idea pops in your head that you want to bid a job, what's the process look like in working with the bonding agent and the bonding company, all the way through getting the job, completing the job, and closing it out. I have a presentation like that, and I've been doing these types of things for almost 10 years now. I do a lot for U.S. Department of Transportation, Detroit, Chicago, Pittsburgh, and other organizations. And I've done presentations for PTACs as well. If your customers need help or if you need me to present, I'm happy to do that for you.
Wonderful, great job, Kevin. I learned a lot of information today. One of the things I love about our webinars is you never know, with the presenters, But I want to say to you, great job, thorough presentation. One of the, I think, key signs you can tell that someone is really passionate about what they do and really carries that passion over to you as a small business. I don't know if you heard him say at the beginning of his presentation, he actually looked to see who was on the participants, and he looked you up, your business, just to see, you know, kind of what industry you're in, construction related, so that he can make the presentation, you know, kind of answer any direct questions, see if you were in this line. Now, we didn't do any direct marketing specifically for construction related projects for this webinar per se. We just did general marketing for all of the webinar series for the matchmaker. But what we would like to do, again, as I have mentioned, next fiscal year, is to really have a more targeted approach for you and Chandretta to come back and present. I really loved the background information that you gave about surety bonding. And, you know, there's a proverbial statement that says, and all that getting, get an understanding. And so you gave a definition about surety bonding and even the biblical reference. And I was like, wow, I hadn't heard that, but it does make sense. It really makes sense. So sometimes doing and getting involved in these programs and taking advantage of the tools and the resources, the bonding program, access to capital, having a better understanding about how it works, where it comes from, the history of it. I think you gave a little bit more history. I have been on some surety bond, SBA Surety Bond bonding webinars, maybe a couple years ago, but I think you added some additional information that I wasn't aware of. So I actually think what we may want to do, we do partner with PTAC and do a government contracting series, as I said, is to have you and Chandretta come back and maybe lay a foundation with a surety bonding 101, then maybe have Chandretta speak, and then you come back and talk about a couple other things, and we can spread it out over a couple weeks. But wonderful information. Great job. As I said, I learned some information today, so I'm sure some of our firms did too. And even if this didn't necessarily apply to you today, perhaps you may know someone that's in the construction industry, so you can pass this along. This is being recorded, so I do have a couple 8A firms. I work directly with 8A firms that do construction projects. Would love to share this with them. So again, thank you so much, Kevin, for your time. Are there any questions in the chat? Definitely want to address any questions. If not, I believe our webinars will continue, not next week, but the last week. And we're taking a break next week. I think we all deserve a break. We've been doing these like every week, like 2 a day. There's one this afternoon on pricing, contract pricing and wide area workflow at 1 o'clock. So please feel free to join in on those. And then if not, then we'll resume, I think, the week of June 27th. We have a couple more webinars that will be wrapping up that week. And then, of course, the matchmaker will be July 13th and 14th in Dayton. And again, Kevin, I have to make sure I send you the email. We definitely would love for you to come to the matchmaker if it fits in your schedule and you're available. You can join us as a resource partner and come down and hopefully interact with some of the businesses. This will be our first really large event that we'll do since COVID. So a great way as we open it up and starting to network. On the 13th, we're going to have a half day of training. We'll have a panel discussion from agencies doing business with and several federal agencies. Then we'll have a panel discussion of small businesses, just kind of what them sharing some tips and best practices and them doing business with government entities. And then we'll have a networking reception like around 5 on the 13th. We may give out some awards to some 8A graduates. And then on the 14th will be a full day of matchmaking. So if you haven't registered, you can go to the Ohio Business Matchmaker site. That link is in the chat. And then also you can access the recordings for our first presentation with Chandretta Boykins, and then Kevin's presentation that he just gave. And then the slides will also be available. So not only today's webinar, but all of the webinars that we've been doing since June 1st will be located there. And then you can also access the slides. Someone requested one of the slides from yesterday, so I did get those. I will send those to you, Reku. I just got those from Bill. So I think that's it. I do want to encourage, I know the recording is still going on, but it is extremely hot. So if you are having issues, and I know some people's power has gone out, if you are having issues, I know the city has set up some cooling stations. Please check on, your loved ones, elderly neighbors. Want to make sure that everybody stays safe because it is going to be really hot for the next few days. And some people may be out of power for a few days. So if you do need assistance, you can reach out to me, but I do have information about cooling centers. So again, thank you. Sorry about that. Thank you for everybody's participation. Stay cool and have a wonderful day. And if you can join us at 1 o'clock, Jill will be facilitating that webinar. Thank you, Sharon, and thank you, Joey, for staying on. Joey, we were joined by Joey Scott, who is the statewide PTAC manager, and so grateful for his support of this as we've been doing these webinars and just the whole matchmaker event. We have wonderful partners, a collaboration of partners to put this on. Thank goodness it's not just one agency or one person. We've been doing so much, so we're grateful that the PTAC, the Minority Business Assistance Centers, the SBDCs, the SBA, the state, Ohio Department of Development are really partners in putting these webinars together, and then the whole matchmaker. So we're just grateful for everybody's participation. And most importantly, you as small businesses. So thank you so much for joining us. Again, thank you, Kevin. And everybody have a great day. Stay cool and enjoy your day and enjoy your week.